My name is Michael Gayed, publisher of the Lead Lag Report. Joining me for the hour is Tadas Viskanta, who puts out this phenomenal website and curation of content through Abnormal Returns. Tadas, for those who are not familiar with your background, introduce yourself. Who are you? How'd you get interested in markets? And how in the world did you get that domain? Because I'm really jealous.
Oh, wow. A lot of questions there. Well, I have been interested in markets for a really long time. So, not to date myself, but I am past 50 years of age. So, I've been in and around markets for probably 3 decades now. So, I kind of come at this with a relatively deep background in terms of experience and education and reading and all of that. And so, blog, Abnormal Returns, which I've been doing now, just passed its 17th anniversary a few weeks ago. So that gives you some sense for how long I've been doing this. And in regards to the URL, I started this 17 years ago. So it was a lot easier to get a decent domain name. And at the time, I literally just pulled up a dictionary with finance terms and just started going through it and just started jotting down which names I liked and saw which URLs were available. And this is the one that I landed on. So it stuck.
I think one of the things that people correctly know you for is being a phenomenal filter to a lot of the investment research and analysis that's out there. Talk about how you go about finding research, what makes you interested in a particular form of analysis, because that filtering is, I think, increasingly hard in a social media driven world where you've got professionals and non-professionals both having an equal playing field in terms of their voice and what they want to voice from their research.
Yeah, I can't. One thing I can only speak to how I approach things. So I don't know that I can really say what other people do or how they should do it. But for me, and with that caveat is important because I really hook myself up to the fire hose and let it flow over me. And when you do that, and when you do that on a consistent basis, you begin to see trends, you begin to see connections, you begin to see who's writing about certain things and who's doing it well and who isn't. And so it's really, in that regard, it's very much sort of that curation is really through osmosis as opposed to some sort of formalized checkbox process where you're going through and trying to find, certain things. And so in that regard, I really let the content itself hopefully drive the curation. So I don't want to I try not to overlay what I'm thinking or what I'm feeling or anything like that over what I'm seeing. And so, in that regard, you really have to let the content sort of speak for itself.
And is it more the conclusions from the content that get you interested, or the way the analysis is conducted, right? Because for the most part, you can tell where most people think markets will go, right, based on sentiment. But so that's not really that interesting. But oftentimes, I think it's the way that somebody gets to the right of the equal sign that matters.
Yeah, absolutely. Yeah, I'd rather read an interesting analysis that ends up in a different place where I think it should than vice versa. So, yeah, I mean, I think that is the kind of that's gold, where somebody's coming at something from a different perspective, different angle, new data set, something like that. So that's what you're really hoping to find. And so, some days that happens more often than others, but yeah, that's really what you're looking for. Is it doesn't have to be a divergent viewpoint, but I think it's just somebody coming at things from a different angle. And so that's just, that's important, not just in, our domain, finance, but I think we see that in popular culture. We want to see something sort of, we want to see something new. We want to see somebody kind of take a form and twist it around and change it a little bit and give it their own personal sort of tweak. And so that's when something is really exciting or interesting or grabs our attention or really drives you to say, hey, you guys should really watch this or listen to this or read this book or something. So I mean, I think that's what we're all looking for, whether we want to acknowledge it or not.
Speaking of seeing something new, as I've made this point repeatedly this year from a lot of perspectives in terms of the way that I look at things is all kinds of new relative to the historical data set, not just in terms of inflation, the speed of interest rate hikes, but interaction of different asset classes to each other. Talk through to the audience some of the more interesting research that you've come across this year as an explanation for why markets have been doing what they're doing. Because I keep going back to, especially when it comes to stocks and bonds, saying that they both lose money is very different than identifying how they interact and lose money together.
Yeah, no, I think that is the story of the year. So I don't think you even need to, we touched on this a little bit. I mean, I don't think you even need to do much analysis in terms of the bond market other than to say, we're sort of in unprecedented sort of historical territory, not only in terms of the drawdown in the bond market, however you want to define it, but also, like you said, how that drawdown is coming at a time with, I think, if you were to look at the stock market on its own, you would say, this is a pretty run of the mill sort of bear market. When you look at it from just a sort of if you were just looking at it from a very basic sort of statistical perspective. But when you tie that together with the performance in the bond market, that's where you get the sort of where that Venn diagram overlaps, is where you get sort of this, where you're really sort of going into unprecedented waters.
Yeah, and I think that's, I mean, that goes relates to 60-40 and all these charts I've put up on showing as far as the drawdown in treasuries being more than the drawdown for equities, first time in history that's ever happened. When you look at the research and the way that it's unfolded and covered what's happened this year, has there been anything particularly noteworthy from different sources that you look at that, again, maybe would suggest that this is either something we've seen before or not seen before? Because I think this point about the way the year has played out, it's always a question mark of what do you do when you're in an anomaly, and everybody always wants to anchor on to some historical data point for some parallel. But I've myself yet to see anything that's really anything similar to this.
No, I mean, I think in that regard, you're right. I think we are in sort of an unprecedented situation. We essentially, pull up any sort of yield chart. We're essentially going through a decade-long period of super low interest rates, and I think we all sort of became inured to that. And there are some, and I think there were some very good reasons why interest rates were low during that period of time. Not only just because of what the central banks were doing, but sort of an overall period of disinflation. And then when you get, I think what's challenging for anybody sort of looking at this, that you go from, we've kind of gone from unprecedented event to unprecedented event. You have a pandemic which essentially overturns, shuts down the global economy, and then eventually we try and creakily sort of start it back up again. And so that's nothing that we've lived through in our lifetimes, at least, for sure. And then when you layer on top of that, a war in Ukraine, again, that sort of upsets all manner of existing sorts of trade relationships and commodity relationships. I think we're just kind of going from one sort of crisis to another. And so to have predicted what was going to happen or anything like that, I think would have been, a sort of a Herculean effort. But I think when you go from a period of time where you have such unprecedented low interest rates to a period where you have, again, a spike in inflation that some people may have seen coming, but which was faster, higher, and more global than anybody really sort of would have thought. I mean, I think it's, it's like going from, having the accelerator down full bore and then slamming on the brakes. And whenever you do that, stuff's gonna break and tires are gonna squeal and things like that. So I think that's what we're living through, and I think that we're starting to, beginning to come to terms with. And I think, markets are, as the Fed has evolved over this past year, I think people are beginning to slowly sort of come to terms with what's happening. And we're still going to see, it's going to take a while for all of this to play out. There's probably some things that are still going to break in the economy. I don't think, I think calls for a recession earlier this year were premature, but I think, that's certainly on the table for, the rest of this year into 2023. So I think those things are still on the table.
Let's talk about bias for a moment, because again, you're known for putting together a curated list of thoughtful content that you come across that you find interesting. I gotta imagine it's hard to filter through the things which are more objective, especially when algorithms unfortunately reward more extreme views or those that are louder in the way they communicate. I know this myself, right? I've pivoted my own Twitter account to be louder because the reality is I started getting more engagement that way. I mean, it's just the reality.
Sure.
But I do think that there's an aspect to being, from a professional perspective, mindful of biases in research that you're reading. So how do you try to filter through the biases beyond the conclusions or the process being good or bad?
I think I guess my best explanation for that is that part of it is really just having put in the time and having done this enough where you begin to see patterns and you begin to be able to sniff stuff out from the outset. And so, it's probably, I hope that it's become more difficult for people to fool me or to suck me in than it has been in the past. And so, and I think part of that is that the sort of, I'm going to just for lack of a better term, clickbait junky sort of content is just, it's more obvious now, at least for my eyes. And if you can avoid all that stuff and not waste time on it and not get sucked in, I think that's really helpful. That gives you a little bit more room to spend time with content, which is hopefully a little bit more thoughtful and even-handed, and hopefully comes from things where a more sort of authentic sort of perspective. And a few weeks ago, I wrote a piece about authenticity, and that being sort of the key to longevity I'll call it the content game, but I was, really speaking about our sort of domain. And so, it's easy to make a splash. I mean, I think anybody who has been doing this for a while can make a splash on social media, on a blog, go on TV, go on a podcast or whatever, and gain a lot of attention. And, you can go, it wouldn't be too hard to quickly sort of rattle off a bunch of names who are able to do that. But being able to do this over time and being able to do it with a little bit of dignity and keeping sort of your kind of, for lack of a better term, kind of keeping your soul intact, I think is hard. And I think the people who do that are really authentic. And they are really, they're writing about stuff that they believe in, and they might be wrong, they might be wrong, they might be right, they might be wrong, but at least they're authentic. And I think they're coming at it from an honest perspective. And I think that's really all you can ask from somebody. And so, like I said, a lot of people come to me for advice about wanting to, to do this sort of stuff. And that would be my advice to them. And, the chances of you breaking out and becoming, star, I think, are limited. Like any sort of creative endeavor, the chances of that are pretty low. But I think if you come at it from the perspective of being in the game for a long time and doing it with some honesty, I think that's all you can really do, and sort of let the chips fall where they may.
I agree, but I think the problem especially with social media, Twitter in particular, is that I think people think the authenticity comes from the results, right? What happens after the equal sign, whereas you and I both know real authenticity in our industry comes from consistency of process and an approach, right? And the problem is, of course, that you're going to be wrong, as anybody would be in any process or way of thinking about things, because noise comes in, cycles come in, there's an element of luck. For those that come to you and are looking for suggestions on how to frame their own content, how do you help them through that point? Because you can be authentic all you want, but again, unless you get a few big things right, it's hard to get people to pay attention to it.
Well, no, I mean, I think that's true. But I think, like I said, you know, it's easy to start a blog. It's easy to start, excuse me, it's easy to start a podcast. All of those things are sort of, sort of somewhat trivial to start. But you're only going to get traction with it if you're able to stick with it. There are all those statistics about, the average podcast on a podcast platform has, a half dozen episodes. And so most people start and they realize that it's really difficult and they end up quitting, which is fine. I think there's only one way to find out whether it is really for you, and that's to actually start. But I think, recognizing that it's going to be a long haul. And I think you have to be able to live with yourself. You have to be able to look yourself in the mirror and say, you know, am I doing this for the right reasons? And am I getting something out of it? I think a lot of writers, especially, will say, look, I'm just writing I'm writing for myself. I'm writing to process my own thoughts, to get my thoughts down on paper, see if they make sense. And so, and if there's an audience for it, great. If not, I think that's really the key that you see with those people who are able to do it and stick with it, is that that they're getting something out of that process, and it's valuable for them, whether they have 10 readers, 1,000 readers, or 100,000 readers on a regular basis.
All right, so let's go back to the name of the site, right? Abnormal returns. So bonds have been a big story, but I think from an investment perspective, you can argue that another big story is really the behavior of managed futures, which have been one of the few bright spots this year from a alternative strategy perspective. Let's talk about managed futures for a bit here. First of all, explain in general what managed futures are for the audience, and talk about how they've broadly behaved this year and why. I mean, I know the reason, but let's go through it.
Well, I think we have to split it up, and there's two sort of separate things. Managed futures is really simple, is really a description of a type of fund, fund vehicle, and so that's a vehicle that invests in futures contracts, whether it be, and that includes the whole laundry list of things that futures contracts cover, that include commodities, equities, rates, and currencies, sort of everything. There's futures contracts that trade in the United States, and then there's futures contracts that trade on exchanges, around the world. And so that's really just a sort of a generic sort of description of the vehicle itself. But I think when we're talking about managed futures, we're typically talking about managed futures which follow some sort of trend following algorithm or strategy. And so that's really, this year has been one in which those managers who have been trend followers, who have really seen, not just this year, but last year as well, who have seen pretty strong gains. And so starting with commodities, probably in 2021 and then into 2022, you have the trend in interest rates, which has driven returns to a great extent as well. And so a couple of things. So one is, obviously, the returns for these strategies have been great during a period of time in which traditional major asset classes like equities and fixed income have been pretty poor performers. So that's certainly one interesting aspect of it. And two is, those managed futures strategies really rely on trends that happen, and those trends that will persist over time. And so the worst thing for managed futures strategies are, trends that start and then quickly reverse, and those positions get whipsawed. And so what those strategies are taking advantage of is those trends that happen, and sort of the volatility from those trends that happen and that continue on for extended periods of time.
And one of the, correct me if I'm wrong on this, but when I myself looked at a couple of the holdings of some of these managed futures funds that have done well, a lot of that trend following, which explains a good chunk of their performance, is riding the dollar, right? The dollar being quite strong. The currency side has been probably more trending than anything else. From your experience, Tadas, when you have these strong outlier type of returns in managed futures, is there anything that one can glean from it on a go forward basis? Because going back to '08 as an example, as I recall, managed futures did quite well. Everyone rushed into them, but that was pretty much the exact wrong time to do that, because then the bottom was in.
Yeah, no, I don't think you can. I think I don't. I think you're absolutely right. I mean, managed futures strategies are going to look probably their best and maybe potentially the worst time possible to invest in them. So I don't think there's anything to be said for, or I certainly haven't read anything that says that it's possible to time, the managed futures, the returns to managed futures sorts of strategies. So I think that's sort of a siren song that we oftentimes see in markets. But two, I think it's more of a, I think everything, I think just about everything that I've read and a lot of people that I listen to would say, yeah, I mean, in terms of strategies, managed futures make a whole heck of a lot of sense from a portfolio perspective. But the challenge is, look, like you said, we've gone for a decade plus sort of time period when managed futures would have been a drag on portfolio returns. And I think it raises this sort of existential question is, when it comes to any sort of investment strategy, managed futures, or, if you're in the equity market, some sort of factor exposure, how long what sort of confidence do you have in that strategy? How long can you hold on for a period of underperformance? Because any sort of strategy, whether it be, a more systematic one like trend following, or more discretionary, let's say an active manager, how long can you hang on during those periods of underperformance? And I think that's, maybe that's a $64,000 question for investors is, how long can you hang on during those periods? Because they're going to come. And how do you deal with that psychological adversity?
And a good portion, I think, of why managed futures haven't done so well over the last decade is because of whipsaws, right, around the trend following signals that they follow. And I made this point before many times to us that it's very hard to beat the S&P when the S&P is the only game in town, and when the S&P is being driven by a small segment of stocks, you get whipsawed with relative momentum trends. I know this from a systematic quantitative backtesting perspective. Do you think that, if I'm right, if that thesis is correct, that one of the reasons managed futures did poorly is because it was a FANG world for a while there? Do you think that if that's broken, that if we see sort of more breadth in movement, that's more beneficial for managed futures, or is it more just a function of capturing some major asset class trend, particularly on the currency side?
That's a great question. I think the one thing that we can't know, and which is, again, I think, again, maybe I'm in an existential mood today, but I think the one thing is that we can't know is, not only did we have, low and falling interest rates for the past decade, but we've had that for the past 4 decades. And so a lot of what we know about markets has occurred during this period of time of generally falling interest rates. In 1980, short-term interest rates were 20%, and they went all the way down to zero. And now obviously they're back up again. But how much, it just kind of raises a bigger question is, of what we know about markets, how much of that is a function of what happened over the past 4 decades? And obviously, nobody expects the next 4 decades to play out like the last 4 decades. And so what can we take from what did we learn over that period of time, which is not only relevant for that period of time, but is relevant going forward? And I think you're right. I mean, I think if we sort of normalize interest rates, let's say we stick in this, instead of living in a ZERP world, we live in a world of where the Fed funds rate goes in a range from 3 to 5%. I'm just throwing that out there as an example. Does that allow for a lot more? I'm using the term rational just in the sense that, does that allow for trends and interrelationship between markets and asset classes to sort of normalize, and does that make managed future strategies more viable going forward, or at least more competitive against what they were in the prior regime? And so I think that's really interesting. And I think that's, these are sort of the big sort of the questions, which, I don't know that, again, there may not be an answer for these. They really might just end up being, look, here's what I think is right, and I'm going to have to make this bet. and and hope that over the next decade or so that these sorts of things play out.
Yeah, no, I think that's absolutely right, and you kind of hit on something which is something that I've always thought about, which is that I think people often fool themselves when they think about asset class dynamics or certain things going on in their portfolios based on some historical precedent where the sample size is one. Right? A lot of the things I find often on FinTwit will refer to dynamics in a cycle that maybe the cycle itself was the anomaly. So maybe the last 10 years was the anomaly, maybe the last 40 years was the anomaly. Well, then if that's the case, to your point, nothing that we're looking at from the past really matters on a go forward basis. As long as causation remains the same, you have some confidence, right? But that's always the challenge when it comes to investing. People want to anchor on to something in the past, but we don't actually know if there's enough data points to know if there's really validity in the comparison.
Yeah, and let me just complicate it further. So, like you said, do we have enough data? And of course, if from a quantitative, a quant is going to say, I want more data. Give me more data if possible. But the challenge, I think another sort of big picture question is, what value is data from a period in which, what value is stock market data from before 1900 or before World War II?
Right, or pre-gold standard and post-gold
standard. Or pre-gold standard, or pick whatever whatever date in which there were sort of big huge changes that happened. And so, yeah, I mean, does railroad equity data from the late hundreds, is that interesting? Sure, yeah, it's sort of interesting, but I don't think it tells us a whole lot about. I don't think it tells us a whole lot about the stock market in a world, in a very different world. And so I'm always wary. I mean, so it's push pull. You want more data, but is that data really going to tell you anything about the future? And so, yeah, again, I think that these are these sort of big existential questions, which, whether we know it, whether we realize it or not, we're sort of grappling with. And so, we're all sort of, I think that's part of the challenge, is being able to test your own sort of hypotheses. And, we're all walking around with models of the world in our heads. And sometimes we need to take a step back and say, does this thing I believe really make sense given what we know and the data that's out there? So,
no, what's interesting about that is also that as I present to CFA chapters across the country, the research papers that I'm known for are back tests. I've got strategies which are back tested. I'm having a hard time this year, sure, but I always find there's two schools of thought when it comes to thinking about markets, right? Those that don't believe that in back testing, and those that believe in buy and hold. And I always go back to buy and hold as a back test with one trade. And I say that because part of this discussion, I think, around data and models is the assumption that stocks are going to keep going up for the long run. And the reality is we actually don't know if that's going to be the case, except with hindsight. I mean, certainly, the back test of buy and hold for Japan failed starting 1989. So how do you think about that dynamic? Because, again, nobody knows what tomorrow brings. I think people assume that the future will look like the past. And that assumption obviously can be very problematic for anybody trying to manage, wealth.
No, 100%. And I think, I haven't written this, but I've seen other people write this. I know my colleague Ben Carlson, who writes the great blog Wealth of Common Sense, is, yeah, I don't think, I get frustrated when people say, we need to calculate the equity risk premium down to the second decimal, like that's somehow helpful. I think in terms of, at least in terms of the discussion about the equity markets, I think you just have to, you have to have some level of optimism that the future is going to be better than the present. And so you don't necessarily have to put parameters on it. I don't think you need to say what that looks like, but it just says that, on average, humanity, broadly defined, is going to be able to continue to make life better for itself. And so obviously that looks, we can all list any number of sort of existential challenges which might call that into question. But if you don't have that optimism, then you really shouldn't ever buy stocks. If that's really how you believe, if you believe the future is going to turn out a lot worse than the present, then you probably shouldn't be in the stock market, and you shouldn't be taking on that risk and the volatility that comes with investing in equities. And so, no, we don't know what's going to happen. I mean, I think that's, I think, to the degree to which we rely on history is, history is in one respect, as you said, that's all we have. All we can do is look back at history and see what happened. We don't necessarily have to project that out into the future, but at least when it comes to the equity markets and the stock market in general, I think you have to be able to answer that question for yourself about some sort of belief that the future is going to be somewhat better than the present, and that we'll all be able to, hopefully through the ownership of broadly diversified portfolios, take advantage of that.
Let me reset the room for the remaining minutes here. Everybody here, please make sure you follow Tadas on Twitter, and obviously check out abnormalreturns.com. I've tracked a lot of his stuff for some time. He's one of the best in his industry as far as filtering through noise and finding interesting research. Again, my name is Michael Guy. You wanted to talk about these I-series bonds, which, they've been getting more and more attention and traction in the media. What is it about I-series that you think is worth kind of highlighting? Because it is something which not too many people are probably taking advantage of.
Well, I'm going to talk about sort of from a broad perspective and then sort of drill down. So, we often, I can't tell you how many things that I've read in the past year or so talking about inflation hedges. Bitcoin's an inflation hedge, gold is an inflation hedge, oil is an inflation hedge. Broad-based commodities are inflation hedge, which some of those have some sort of historical validity, and some of them make sense from a sort of an intuitive sort of perspective. But when we talk about a hedge is something that is supposed to move one for one, in the direction that it's supposed to help offset whatever sort of exposure you have. So, so when we talk about inflation, there's really only, from a U.S. perspective, there is really only one sort of inflation hedge, and that's Treasury inflation protected securities. They're going to move one for one. The returns on those are going to move one for one with the CPI, and that's really what you're looking for. So from a theoretical perspective, TIPS make all the sense in the world. But so a few months ago, and there's more, and I think it was even before, these Series I bonds got really popular. I personally went on to the Treasury Direct site, and my experience was horrible. I found it clunky. The definition of user unfriendly, and I was like, I'm done. I'm sure it probably makes sense to be able to buy Treasury bonds and these inflation protected bonds through the site. But I was like, I'm done. I can't deal with the hassle. It's not worth for me to have another account open to be able to do this stuff. And so somebody, I forget who it was, wrote about the return on hassle. Is the return on hassle worth it for you? And for some people it is. There's limitations on the amount of these bonds that you can buy. There's restrictions on your ability to sell them in the future. And so I don't want to get into all the details, but for me, it was kind of a situation where the return on hassle just wasn't worth it. Sort of, as they say, the juice wasn't worth the squeeze. And so, people, the last, I think a few days ago, the ability to purchase a round of those Series I bonds closed, and people were talking about having all sorts of issues with the website and getting locked out and being unable to conduct their transactions. And, it's sort of reminiscent of what happened a year ago with NFTs and crypto and things like that. People are attracted to the hot new thing, and it just goes to show you, the venue, is a 180-degree switch from what was happening a year ago, but it just goes to show you that we all sort of are attracted to the hot new thing. And in this case, at least for me, the return on hassle just wasn't worth it. So,
what's interesting about that? I like that return on hassle way of framing it. I mean, I think everyone would agree that if they were to look at their saving rates at their local bank, wherever they bank, they're probably not seeing it go up that much. Certainly not at the pace of interest rates, certainly not the pace of inflation. But a lot of people, I think, are probably too lazy, for lack of a better way of saying it, to either insist on higher returns or even move to a different bank, right? But that's what you need to do to generate some return because it's a hassle.
Yeah, no, absolutely. Yeah, no, there was an article this week talking about how a lot of the big banks are offering offering brokered CDs, and so those are CD certificates of deposit CDs that they sell through third parties. So Fidelity, Schwab, whatever, sort of the big brokerages, you're able to purchase a lot of those big brokerages allow you to purchase CDs from some of the big banks. And this article is talking about how the rates on those CDs that you could purchase through brokers are a lot higher than the rates that they're offering their own customers. And so it just goes to show you, again, sort of that return on hassle. You do have to kind of take an additional step to see where it is that you're able to generate higher returns. And sometimes it's worth it, and sometimes it's worth it, and sometimes it isn't.
Yeah, I'm sure you've seen some of these studies too that would argue that CDs are certificates of deposits are better than bonds in a lot of ways because you have the protection from the government side, right? And rates are pretty attractive, so it actually ends up being better from a risk adjusted perspective. Do you think that part of this is just because CDs have earned nothing for so long that people almost forgot about them as a viable option to make money from?
Yeah, no, I think collectively our certificate of deposit muscles have atrophied over the past decade. I mean, I'm old enough to remember when, banks used to tout their CDs and the rates that you could get on them. And they were, back in the 1980s, those were really, you could generate double digit annual returns from certificates of deposit. And so we're a long way past that. But I think as things normalize and rates sort of work their way through the system, it's not going to happen overnight, but eventually, again, those rates are going to start creeping up and will again look attractive to people. And again, CDs are sort of a DI. This is sort of the realm of DIYers. This is something that you can do and build on your own. And, it's not necessarily something that, third parties are going to do for you. So,
yeah, no, I think that's right. Okay, let's pivot a little bit because I think I always find this to be an interesting discussion, which is the role of skill versus luck in any endeavor. All right, so certain domains are more likely to you can more likely attribute your success to skill. Now, if you're a surgeon, there's a degree of skill there involved in terms of doing what you need to do. If you're an investor, there's skill, but admittedly, there's also a degree of luck, both good or bad. Yeah, I always go back to that equation: success equals talent plus obsession plus error, right? And error in that equation is luck, positive or negative, good or bad. Talk about the role of luck from your experience in when it comes to investing. Is it a bigger component of one's investment returns over time than you think most want to admit? How does one position themselves to get lucky in the investment industry? Just talk through that dynamic for a bit.
No, this is a huge question, and we could talk about this for hours on end. So, my thinking was really influenced by Michael Mauboussin and his book The Success Equation, which is really all about this idea of luck and skill and being able to tease out in which domains is luck important or skill important, and all of those things. And so I think we overlook the impact of luck on our returns. And so we can take it from a couple of different perspectives. And I'll just stick with this. I'll start with sort of the big picture perspective is, look, if you started, there is sort of generational luck in a sense. If you started investing, let's say you started investing in stocks in 1982, you've had essentially, obviously there have been some hiccups along the way. You've had 40 years of pretty good luck in terms of the returns that you would have gotten from just doing sort of basic blocking and tackling in the stock market. If you would have tracked the broad indices over that period of time, you would have done really well for yourself. If you'd have been socking away money in your 401k plan or your IRA, or eventually, Roth IRAs down the line, you would have done pretty well for yourself. And then you would have done that without a whole lot of skill. And so we have these sort of big sort of macro sort of luck, which we all think, we need to take into account when we're thinking about some of these things. Somebody who, let's just talk about luck and skill. If somebody was locked in a new mortgage or refied their mortgage, anytime in 2021, they're looking at a mortgage rate of, 2%, it either has a 2 or a 3 handle on it. And somebody, for whatever reason, who needed to be in the housing market this year is, looking at a mortgage rate of, 6 and more likely 7%. Is that skill? Maybe there might be a little bit of that. Is there luck? Yeah, there's probably some of that as well. And so some of these things we just can't, some of these things are big, broad trends that are really difficult to fight against. And so I think we have to be really mindful of that big picture sort of luck. But I think if you start drilling down even further, I think it becomes it's hard to tease out luck and skill when it comes down to individual managers or strategies. We talked a little bit earlier about, what sort of data do you need to be able to make sort of confident statements about certain sorts of things. And when it comes down to that sort of level, it's probably the case that we don't have enough data to be able to say somebody is lucky or skillful. And so I think those are real challenges. And I think all you can do from sort of a user experience sort of perspective is just recognize that luck plays a big role in not only in life, but and also in financial markets. And so I don't know that there's a good way. I don't know that I'm smart enough to be able to say how much of what happens is luck versus skill. But I think the big mistake that people probably make is underestimating the role of luck, both good and bad, in outcomes.
But I do think skill can help you survive when the error is negative, when you have bad luck, right? So let's say you're an equity fund manager and you launch a mutual fund or an ETF, at the very start of 2008, and you're managing to prospectus. Bad luck, right? I mean, horrible timing. You're not going to be able to get assets for a couple of years, but you've got to try to keep on building your business and survive. So I always go back to this point that the macro environment is what helps you thrive. The micro effort is what helps you survive. The macro environment does have I think, a lot more luck than one's effort in trying to survive, right? Although obviously there's luck there too. So in other words, I'd argue that luck is a bigger portion of investment success on the up capture side, whereas skill might be more skill in terms of surviving those cycles is more on the down capture side.
Yeah, no, I think that's a good way of putting it. And I think you could broaden that out from not just from an investment perspective, but that's really sort of a perspective in, to, let's say we broaden it out to business and entrepreneurship and startups in general. I mean, I think if you go at a problem, so in the investment side, the problem is trying to generate returns. And if you're looking at it from a business perspective, is trying to generate revenue and create a sustainable sort of business. Preparation, luck plays a role, obviously, but preparation, capitalization, all of those things play a role in being able to find out whether that thesis that you have is correct. And yeah, I mean, I think that's absolutely the case. And I think sometimes in the investment business, we see people try and hack that process. And so if you think about the entire business of thematic ETFs, so let's say, either based on themes or based on really small slices of the sector space, what you see is, fund companies throw a lot of spaghetti up against the wall. They launch a lot of these funds in the hope that at some point down the road, one of those funds is going to take off. The returns are going to take off, assets are going to flow in, and that will pay for for the funds that don't pay off. And so,
right, it's basically survivorship bias. This is sort of a
yeah,
well-known thing in the business of manufacturing ETFs, for example.
and to some degree, some people launch. Again, I don't want to paint with too broad a brush. Some people really do launch those funds because they have an honest belief that this theme or sector or strategy is really one that is worthwhile. And, I'm not trying to denigrate that, but there is another side of it is, look, if you launch 10 of, there's the more cynical side. Look, if we launch 10 of these things over the next 5 years, one of them's gonna hit big, two of them are gonna do okay, and the rest of them are gonna be, gonna end up being losers that we have to close. That is sort of a, just essentially taking skill out of the equation and just and basing your belief that, given the cost that you have and your ability to market those funds, is that luck is going to pay off at some point down the road and make for a compelling business down the road.
Which and that I think is actually something that probably most of FinTwit hasn't thought of, because when you're in the industry and you have massive resources, that's exactly why the big stay big, right? Because they've got a resource to launch multiple funds, right? Which is a very expensive endeavor, but they can launch tons of funds. And yeah, sure, it's sunk cost fallacy. If it's not working, then you close it, and then you're right. The odds favor that one will hit big, and then once one hit bigs, then you have more resources, and that's how the very large stay large, because effectively they're also getting lucky in their own product launches.
Yeah, I would think that. I mean, I'm certainly not an expert, but I think the one interesting thing I wrote about this a few years ago, and I think the one nice thing is that the cost of launching at least ETFs has come down, and so I think that does allow for more experimentation, more innovation, and so I think that's one. I wrote a post a few years ago entitled "Keep ETFs Weird," and the idea was one of the byproducts of the ETF sort of revolution has been that it allowed for smaller firms, let's say, to launch new strategies, more innovative strategies, that we wouldn't have seen in the past if that structure weren't in place and the cost hadn't come down.
Yeah, no, that's 100% right. Now, just maybe just kind of wrap it up. And again, everybody here, please make sure you follow Tadas and check out abnormalreturns.com. Just rounding out this discussion around luck for a moment. You're, I believe, managing separately managed accounts, so you're managing other people's money. You and I both know that luck is not exactly a good selling point when it comes to trying to raise assets, even though it's the truth and the reality around investment returns. How do you get across to clients that there are going to be times when their portfolios are in a period where it's just not, the luck's not favoring them, right? Because I think people always, who are not in the industry, and even those in the industry, assume that when you're in a drawdown or when those portfolios are in a drawdown, it's because of skill, and it really could be just to be a function of poor luck, poor cycle, poor timing, whatever you want to call it.
That's all communication. That is communicating upfront with people that our best understanding about how markets work, and that the key is, so communication first and foremost, from the beginning and all the way through the entire process, and on an ongoing basis. And so, I think that's the only way to handle it. And I think part of that process is making sure, and it doesn't always work out 100%, is when somebody comes on a client, is that they understand your process and that they buy into it, and that they understand that that road is not going to be a straight line. And so if somebody, I think Barry Ritholtz, who is the chairman and CIO of the firm, wrote in a blog post a while ago talking about how somebody early on in the days of Ritholtz Wealth Management came and said, somebody with a particularly large amount of money said, look, I'm going to get, part of it would essentially wanted to engage in a bake off. He said, I'm going to give these 5 money managers a certain amount of money, and after a year, whoever has the best performance, I'm going to shift my money to them and, give them my money going forward. And Barry and Josh were like, thanks, but no thanks. That's not the game that we're going to play. Anything can happen over a year. And if that's what you want to do, that's fine. You're welcome to do that, but we're not going to play that game. And I think that's so that's the right way to think about it. If somebody isn't willing to buy into your strategy up front, then they're certainly not going to be able to ride out the ups and downs, which are inevitably going to happen.
But I gotta assume that more and more people think like that, because as I've ranted on many times before, right? Short termism has never been in a bigger bull market than we've seen, right? I mean, if you look at studies in terms of attention spans, being shorter over time, the fact that you have vines and snaps and all this stuff, which is these kind of snippets. I gotta imagine it's harder and harder to find the right type of client that can understand that. And one thing is for them to obviously say they understand it. Another thing is, in practice, do they, when they're actually choosing you as an advisor?
Well, I think there's a couple of things going on there. One is, I can only speak for our firm's experience, and I think our advisors are very attuned to those clients who have the potential for saying one thing and doing another. And so they have enough reps, they have enough experience where they can sort of read between the lines when somebody says, "Oh I buy into what you're saying. Yeah, I'm good." Versus somebody who's like, who is really sort of buying into it. And I think from that perspective, so I think for a firm to be successful, you don't need every prospect to turn into a client. If that's the case, then you have a much bigger problem. And so being able to be selective in terms of your clientele, I think, is important, because it helps the client, but it also helps you from a management perspective as well. If you're not, we always talk, the squeaky wheel or that nail that's sticking up. If you're always dealing with those people or with those clients or those people who are challenging you on an ongoing basis about perspective or what happened in the market today or the day before, that's not good for anybody. That's not good for the client, and that's not good for the advisor. So that's essentially a bad fit. And being able to avoid entering into those relationships from the get-go is important. But I would say, I would say from a larger perspective, I think certainly Vanguard is certainly, there's a lot of self-selection when it goes on to clients who are at Vanguard. But I think you see from the data that Vanguard puts out, the behavior of those clients is pretty good. We've had some challenging times, with the pandemic and everything else. And I think I think there's a lot of noise and storm and drang from, on the surface. But I think for a lot of people, a lot of investors have internalized the lessons of diversification, low costs, and I think so. I think there's sort of two things going on there. I think under the surface, a lot of investors are doing well from a behavioral perspective, but on the surface, there's always a lot of noise going on the surface.
Yeah, 100% agree. Again, thank everybody for joining. I always like listening to Tadas. Please make sure you check out abnormalreturns.com. This will be available under the Lead Lag Live banner as a podcast. And everybody enjoy the rest of your day.